All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Um, uh, a lot of stuff's been going on, right? A lot of stuff's been happening this week. Market, and we talked about it at the beginning of the week. Perhaps more going on this week than any other week this year. There might be a week in October where a little more is going on, but U.S. President Trump kind of changed that yesterday by adding, more trade drama to the markets. And I mentioned yesterday some things had changed. Right, we saw the market metrics change. We saw the market vibe turn bearish. In fact, the market vibe had been in a neutral territory most of the month, and up and flipped bearish yesterday as we saw. A lot of the market internals erode. Things like the bullish percent index that have been very flat here of late, has had a very, well, I shouldn't say sizable erosion, but has had enough of an erosion to create a bearish signal, even with the bullish percent index. And that's before today's move. So, we see in a lot of the market metrics, number of stocks trading above key moving averages, new highs, new lows, the aggregate volumes, the performance of different sectors. It turned yesterday in a way that we haven't seen it turn all month. The last time we saw it turn that way was in May, right? The last time we saw the market vibe turn down. So we are in that type of situation right now where the market vibe has turned bearish. So you want my thoughts on the market? Yeah, right. I have to understand the path of least resistance right now is down. Now, a bearish market vibe has two meanings, right? Like a bullish market vibe. Bullish market vibe has two meanings. Path of least resistance is higher, volatility is going to be lower. Bearish reading means path of least resistance lower, volatility is going to be higher. And I mentioned this morning in my note that we're going to see multiple moves here here today in the market. And just after I hit send on the note, we had some massive volume come into S&P futures. S&P futures in 1 minute went from 29.46 up to 29.60. That's a 16-point move in 1 minute. Right? And this is a move that was catalyzed by a report out of CNBC that U.S. President Trump may not, go the tariff route with more. It's just more of the drama. And it wasn't anything that was happening. It was speculation about what could happen. Right? So we get this immediate pop, and then that has been faded. Right? So we basically see the market rally over 20 points in a few minutes, gives all that up. Market opens, and within 1, 2, 3, 4 minutes, S&P futures go from 29.36 up to 29.46. A 10-point rally in 4 minutes, right? And then a 7-point sell-off 1 minute later, right? When the market vibe turns bearish, we get this type of action. Just increased volatility, increased movement, and the biggest bullish moves, the biggest kind of upside action that we see almost always happens when the market vibe is bearish, right? And it is just one of those where ultimately we do see that get sold into most of the time. But until we see the metrics change, it's just something where, we're not really going to talk about, hey, you know what, volatility is going to start to contract. Now, yesterday, if you were watching, some of the things near the close of the market and you started to go look at some of the options, right? You noticed option values were really interesting, right? They were heavily inflated compared to what they should be, and the spreads, even on stocks where spreads are normally tight, they opened up. And, when we get into a situation like this with the market makers are just not willing to hold certain prices, as long, right? And so one of the reasons you get sharp moves like this is because, hey, when there's a flood of buy orders come in, the market makers aren't going to sit there and, just fill it all at the price that currently is. They're gonna thin up up. They're going to thin out how much they're willing to buy and sell, and so it increases, increases that volatility element here, and that is, that's what I expect that we will continue to see until we see the market metrics switch. All right. Now, for the challenge, there are no new signals on the board here this morning. And we have some downside crossovers, things like IBM. In fact, here I'll show it to you. The 3 and the 7 are crossing down, right? We had an upside 3-7 crossover yesterday, and I was kind of surprised it wasn't a signal, but ultimately it wasn't a signal, and now we have a 3-7 downside action going on, and it's not a signal. In fact, a lot of the downside 3-7 crossover action that we see, the Stochk 39 looks like this, that meaning the stocks are trading up, in the high side of their range. So, while downside crossover, could lead to a bigger sell-off, is not going to lead to a trigger here for the challenge. We have Vulcan Materials with the downside 3-7 crossover, but also not triggering, and the 3-7 crossover action that we see to the downside almost all looks like this. Valero has a downside 3-7 crossover on it here today. You can see the Stochk 39.1 where that is right here. And, so that's what most of those crossovers look like. There's not a bullish signal on the board, but Arconic had earnings here this morning. And, initially when I ran the scan, about 15 minutes after the market opened, just out of my own curiosity, Arconic was a bullish signal. Now, 15 minutes later, it's not, and it's one of the reasons why we stick to the timeline that we do. This kind of 10:30 a.m. timeline. But Arconic had some very interesting earnings, and I think you can argue some really good earnings. But they do have some headwinds in the name of the market right here. All right. So for the challenge, still in all cash, not going anywhere there with that. Now, we have hit the 60-day mark, and if you'll notice here, did a 30-day summary. Going to do a 60-day summary here. Have most of it finished, but I'm going to take the weekend before I present it, just because I want to, I want to take a look at a couple other things metric-wise, and, so I will do that on Monday, not today. I had planned to do it today, but I do want a little more time, with some of the metrics and just kind of a couple things I want to add into it that I think will be helpful as we go forward. Okay, I will not be on video this afternoon. I will be around, but I'm not going to jump on video. But any signals that come in will be on the spreadsheet. Also, any new trades that happen, the alerts will go out. If there is a signal. As I look at things on the board right now, there's not a lot that's very close to a signal here, but in this market, I do expect that things could change rather abruptly, and if that happens, we'll definitely react here. But I want to go out this morning, and I thought, what would be some of the most helpful, type of thing to kind of discuss here, and what would kind of kind of help in this type of environment. And one of the things you're going to see me post shortly after this video, I'm going to post a video that I did a while back. Last time the market moved into this type of situation, just on day trading, right? On day trading, and kind of how I start to, when the market gets volatile, you can start to jump in a little bit more there. That's kind of how I do it. Everyone thinks, oh man, Jeff, you must be trading all the time. No, I don't. In fact, July, I have not traded very much, just because there hasn't been a whole lot out there, unless you're micro trading. But when volatility start to increase like this, there's a lot more opportunity. So I will post that video about some of the strategies that I use when it comes to day trading that I will be using here today and into next week and going forward, as long as the market remains like this. I will not be day trading for the challenge or anything like that, but anyway, I will have that posted. But I said, you know what? whenever the market switches, whenever it changes, it tends to be a higher anxiety period for a lot of traders, for a lot of investors, and the emotion that you start to see come out of the television and the blogs and everything's got hyperbole, and there's always this news, and is that causing something, right? Because they're bigger moves, so it's always like, oh well, what was the news? What was the news, right? And so it just tends to be a little bit more of a time where it's a struggle, or a greater struggle, to kind of keep in mind what is really happening and what is really changing. So let's go take a look here at what has changed, right, in the market this week, and what has not changed, right? So what has changed? What has changed is pretty easy, and it's something that something that is not going to be a big surprise. But what changed yesterday? Global recession risk, right? Global recession risk absolutely changed and absolutely increased yesterday, right? What else changed? Business costs, right? Because more tariffs, right? More tariffs. China's going to retaliate. Now, China hasn't announced their full retaliation that I've seen yet, but they did announce that they would be retaliating. So business costs across the world are going to go up, right? And so that's that kind of plays into some of the global recession risk here, and then fear, right? I mean, that series of tweets yesterday increased significantly the fear factor when it comes to the market, when it comes to investors, and rightfully so. Rightfully so. That's what's changed, right? That is what has changed, and it's led investors to have to sell, right? Even investors that don't want to sell. Even investors that are holding a stock and they go, I love Amazon. I think Amazon's the greatest company in the world. I don't want to sell it, blah, blah. You have to trim, right? Yeah, you're kind of in a period where the risk factors change, and so you have to trim a little bit, and we see that happening, and it's one of the reasons why some of the better stocks out there actually get taken down, is because there is a little forced selling that does happen in these types of periods. But that's what's changed, right? It's not a heck of a whole lot, and it's something where this could get a lot worse, right? The global recession risk could get a lot worse. The fear factor could get a lot worse, right? But what hasn't changed, right? What hasn't changed? And I think this is the kind of the key to understanding what's happening right here and how to react to it. But what hasn't changed is that stocks are the game in town, right? We've talked about this theme a lot. That, it's just one of those things where other asset classes have kind of just been blown away, right? If fund manager, you can only buy so much gold, you can only buy so much dollar, but when it comes to bonds, there's just not much there, right? So stocks are the game in town, and stocks are still pricey. Now, stocks are pricey on a historical basis, right? When we start to look at valuations of stocks relative to valuations of stocks 10, 20 years ago, stocks are expensive, right? If we start to look at the valuation of stocks relative to where bonds are, stocks aren't that expensive, right? So it's an interesting argument. We can make a really good, compelling argument that stocks are historically expensive compared to themselves. But when we bring the other market factors in and look at how stocks, valuations of stocks when, bonds have been like this, or when bonds have never been like this completely, but when they've gone through their dip stages, stocks are still relatively cheap, right? Stocks are still relatively cheap. What else hasn't changed? The market is still sectoral, right? Market is still very sectoral, right? You look at the market today, and as I speak, the market's down 36 points on the S&P, right? 36 points, AT&T is higher, UPS is higher, Pepsi is higher, Verizon is higher, right? There are still stocks trading to the upside, throughout this, and that will continue to be the case. And this sectoral element that we've talked about for the last several months, that hasn't changed, and it's not going to change here based on what we have seen, so far. What also has not changed are the ultimate incentives of those in power. What do I mean? I mean China, U.S., I'll just say Trump because that absolute there, and then Powell. All three of these entities have tremendous pressure and incentive for the markets to go higher. Now, the markets near all-time highs, they have the ability to kind of, play a little bit, to kind of posture a little bit, to not have to give in to the market completely to drive things higher, because markets have been at new highs. But as markets dip, as markets start to fall, all three of these entities have every incentive to do what? To push them back up. And they ultimately will. They ultimately will. Whether it's warranted or not, they will. And so that hasn't changed, right? So, a lot of what is, what has changed, what hasn't changed, this is kind of how I look at it, going forward. And so from a trade mentality, I don't think it changes much except for, okay, you know what? Yep, all right, you can have greater volatility. You got to understand what the option values are, all of that. From a challenge standpoint, it's not changing anything, right? But from an investor standpoint, right, it does change a few things, right? There are some stocks out there, so let's go take a look at a few. Let's go Bank of America, and I have a stock position in Bank of America, and it is one that I want to add more, to, and it's something I want to be a holder of for 5-10 years, right? It's not something that I'm trading, right? This is something where I'm looking to be a long-term buyer. And I've done that. I've waded in a little bit, piece by piece here throughout the year. And, the position's starting to get a little bigger, but still not what I ultimately want, okay? And here's Bank of America pulling back the last 2 days. And so from an investor standpoint, I look at it, I say, okay, do I want to go and grab some more right here? And ultimately, sure, I could go grab some more right here. It's not a bad idea, right? It's not something where, all right, fine. If it dips more, great. No big deal. But I'm not really going to catch the bottom right here, right? But what do we know? We know option prices have increased dramatically. We can see it in the VIX, right? So option prices have increased tremendously. So one of the things that it allows in an opportunity like this, and wow, Valero, opportunity like this is to start taking a look at put options, right? Because I can come out and instead of buying Bank of America shares right now at 29, I can go and buy them for 28. Right? I can go out and buy them for 28. How do I do that? I go and I sell some 29 put options. Right? I sell the options. What does that mean? That means I have the obligation to buy the stock at 29 in the future, right? When this option expires on the 20th of September. I get paid $1 to do that. So what does that mean? That means my cost basis for Bank of America is really what? 28. So I'm essentially buying it for 28. Now, if it goes below 28, right, I'm going to have an initial loss. But what's the difference? What's the difference in that between, buying right here at 28 and, selling the puts here at 28 or buying the stock here at 29? Well, I get paid the extra buck. Right? I get paid the extra bucks. Now, if Bank of America bottoms right here and just takes off, I'm only going to get that buck. I'm not going to get more than that $1, right? Where if I buy the shares and Bank of America turns around and takes off, I'm going to get more. But in an environment like this where the implied volatility has gone up so much, it's one where you can take a look at stocks that you want to own anyway, and you're going to get paid a lot more by selling the puts than you would a week ago, 2 weeks ago, 3 weeks ago. And so when the market gets like this is an opportunity to look and go, okay, positions that I want to hold for a long period of time, can I start to sell some puts to get into those positions? And it's a really nice way to kind of step into a market that can, be quite volatile, can be quite choppy, can be quite, maddening, right? If you're going to go out and buy call options, you're going to be overpaying tremendously. If the stock dips some, it's going to hurt bad. And, you got to worry about time. If you're selling put options, it's a very different scenario. Just make sure you do have the cash available to buy the shares, going forward. So from an investor standpoint, this is a nice time to start looking at, some of those things. But at the same time, I'm not going to go out and just willy-nilly buy all the Bank of America I can because, boom, it finally had a pullback. When we see pullbacks like this, a lot of times we see a basing out period, right? We see a time where the stock, yes, it pulls on back, but then it goes through kind of this basing process, right? Yeah, and it's not going to be catching the lows or anything like that, but you start to get some bullish candle patterns, you start to get a few reversals, you start to get a little bit of a change in volumes that come into play. And so it's one where, I'm going to go and I'm going to look at stocks that, yes, I want to be a buyer of. I'd like to buy some Rio. I've been waiting for it to come down to the 200-day moving average, and here it is, right? Do I have to go buy it today? No, I don't have to, right? But it's finally coming into an area that I've targeted, so I'm going to take a look at the put options. I'm going to go, look, I can basically buy Rio right here where I can sell the put option, the 52.5 put option for let's just say $250 to make the math easy. It's not quite $250, but let's just say $250 to make the math easy. What does that mean? That means I have to basically buy the stock at 52.5, but I'm getting paid $250 to do so. So my cost basis really is what? It's $50. So I can step in today and I can buy Rio for $50. Not a bad deal. Not a bad deal. At least for me, fundamentally, I think it's a screaming nice deal, to be had right here. What do I lose out? Hell, if Rio bottoms here and just reverses and tracks higher, my max gain is only going to be $250, right? I'm not going to be able to make more than that on it. And so it's one that I'll look at today, and I may sell some put options there, and I may buy some shares there, right? But it's also not something where I want to buy a complete full position and all of that. But yes, things have pulled on back into some areas where some things are tempting. But when you keep in mind something, okay, when markets become, or when we see bearish periods step into the market, where the market vibe turns bearish, a lot of things tend to do what? They tend to overreact, right? They tend to overreact. And so while, yes, my price target, the logical area that I'm looking to be at, where I want to be a buyer at, if they were to just pull back to here on the market, just kind of flat and slightly lower, slightly higher, like what we've seen most of June, okay, yeah, great. I'm going to pick some up. But it's pulling back now with a change in the market, change in some very key dynamics of the market. And so the chance of it overreacting is significantly greater. And so I have to take that into account. I have to say, you know what, there's just something that could overreact. We can see it splash down to 48. And it doesn't mean the stock isn't really a $60 stock. It's just that overreaction element. And we see it happen all the time, right? That comes into the markets all the time. We're going to see Apple pull on back. Is that because, well, on Tuesday on Wednesday Apple was the greatest thing ever, and now 3 days later Apple's terrible? No, right? There's the natural market forces in play here, and so just have to keep in mind that overreactions in the market when the market vibe changes like this are just more common. And so levels, right? Levels don't necessarily mean as much. Support levels, 200-day moving averages, those types of things. You take them with a little more grain of salt, understanding that, hey, some overreactions are to be had. Now, the last thing I'll show are how some of those overreactions, where you can see some of those overreactions and how they're ending. Let's go back to Rio. And I'm just going to put on a simple indicator, and you've seen me show this many times, but the commodity channel index, when markets get bearish, it's my favorite indicator. And it's just one that I think is, best or the most conducive to kind of understanding what's kind of going on and where the market is kind of, all right, is it in its overreaction stage yet or is it not? You take a look at Rio and the commodity channel index is down here minus 200, minus 250, right? When we get into a severe overreaction stage, a lot of times we'll see minus 300 come into play. And typically when you see minus 300 come into play, that tends to be a really nice place to go and sell some puts or to buy some shares. But with a lot of stocks out there, the move that they've had so far, not even close to getting them down to minus 300, right? You see Bank of America, Bank of America went to minus 300 right here, right? Nice time to pick it up, right? Bank of America went to minus 300 right here. Didn't mean the stock bottomed, right? It continued to go on lower, but had you sold puts right here, you're still very happy with how it all played out, or you bought shares, you're still very happy with how it all played out, right? Right here it hit minus 300, yep, and flattened out, went for another dip and rip, but ultimately, you're happy of how it played out, right? So, minus 300 doesn't mean, it's absolutely bottom, but it's a nice place to say, okay, you know what, this is a lot safer place where, my risk is just not nearly as great to kind of call the bottom or try to catch that proverbial falling knife. So, you look at various stocks that are out there. Are they getting to minus 300 on the CCI? Most of them aren't even close. Yep, Apple's had a harsh sell, not even close to minus 300, right? We take a look, Valero sold off the last 2 days, not even close to minus 300, okay? Honeywell, getting closer, right? It's at minus 250, right? So it's starting to track down, towards that level, but not quite there. Here's Boeing. No, not even close to that minus 300 level. Right? So when you look at the majority of the stocks that are out there, and we are seeing some hard sells, we're not seeing very many stocks pushing below that minus 300 level. In fact, let's see if we can go find them. Just for kicks and giggles here, let's just go do a scan, S&P 500, and let's go take a look at stocks where the CCI is below minus 300. So the CCI there, let's take off that parameter there. But the CCI 20 today is a less than or equal to minus 300, right? Well, let's go see if it'll find those for us. All right, 24. These are the stocks on the S&P 500 that are at minus 300 or lower, right? I look at stocks that are on the challenge watch list. The only one we have here is Target, right? So let's pull in Target and see what it looks like, right? All right, we're at minus 300. Okay, this doesn't mean it has to bottom, right? We've seen minus 300 before on Target, right? And it's had dips afterwards. But if you're going to look at a time and a point to sell some puts where, you get a month or two on them or to step in, you're very at this point And this is one of the things that I look for when I'm looking to say, okay, do I want to wade in? Do I want to start buying something? And just kind of something I'm very bullish on, right? I don't do this with stocks I'm bearish on and go, oh well, here's NTAP. NTAP just had a drop today. You know what? The earnings were terrible. It's got some really ugly stuff involved. Well, oh, it's at minus 600. Let me go buy it because the CCI is at minus 600. No, that doesn't make any sense. I only want stocks that I'm super bullish in that look like, hey, baby with bathwater type of action. And, then I'm willing to take a nibble. Then I'm willing to kind of, go after it and, be involved there with it. Okay. So anyway, what has changed? What hasn't changed? Kind of the little bit of the CCI and picking up some stuff, some selling of some puts, and that's kind of how I'm looking at the market. Right here. Now, last but not least, I do want to answer a question that came in last night, and it involved Valero. And yesterday, I did make a decision to sell Valero, even though it had not hit the parameters for the exit. It had not hit the auto exit date. It had not hit the stop level. It didn't hit any of those, and I decided to pull it off. And it's the first time this challenge that I've decided to do that. It's the first time this challenge that I've done step 10 here. While all trade entries and exits follow the algorithm, Jeff can step in under unusual circumstances and change a trade. And yesterday, when we saw the market vibe switch, when we saw just the elements of the market switch so dramatically, I just, it wasn't worth the risk. And if you go back and listen to the video yesterday, I mentioned something specific, that if I hold Valero, right, and we can go look at it right now. Let me pull up the options. The 20th of September, 85 calls, right. So the 85 calls are going for $1.80, right? If I hold it right now and the stock goes against me, the options are going to hurt, right? Down $1. I'd be down an additional 1,500 on it, right? On the trade. Not going to break the challenge, right? It's down 1,500, not going to feel good, but not going to break the challenge, right? It was something where, should the stock bother to rally today because of the extra implied volatility in it, I'm probably not going to see much of a gain. And so if we're in a position where we have a market scenario changing because of where options are now priced, I'm not going to see much of a gain on a rally, and I'm going to see, a 50% loss on a drop. It's just not worth it from an exposure risk reward standpoint. And that is something the algorithm can't take into account, right? There's no way for me to automate that part of it. We looked at different things at different scenarios for stuff like that, but it's not there. And as we go forward, you will see me step in from time to time. It won't be very often, right? And sometimes it'll look good. Sometimes it'll pay off. Sometimes it'll be like, oh, good, not in Valero. Oh, sure, glad not to be in it. And other times, it'll be like, oh, man, Valero rallied $3, after Jeff got out because he didn't want the risk, right? It's going to happen on both sides, right? It's not something where I have the crystal ball and I can say, well, this is what's going to happen, right? And it's not something where I step in yesterday and the question asked, why would I not buy puts on it if I'm going to get out of the calls because I'm worried about the downside? Why not buy puts? Well, it's not so much worried about the downside. It's not liking the risk-reward element of it. And, yeah, I could have gone bought puts, and puts are paying off here today. But had Valero rallied $3 today on some news, those puts are going to sting big because of how much implied volatility comes out of them as well, right? So, that the IV jump, the change in the overall context of the market and the context of the stock, it just wasn't worth the risk, both on the call and the put side, right? And so stepped in, pulled it off, and because I do that doesn't mean, oh, hey, Jeff, change your calls into puts or anything like that. It's just, hey, backing away from the risk and backing away from the risk that I'm willing to take. And that's all that it was. And that's all that it is. And, that's what will happen. And I mentioned when we talked about this Rule 10 here, or, number 10 right here, that the unusual circumstances are not prediction circumstances that, ooh, you know what, Jeff knows what's going to happen. No, there's circumstances where the exposure doesn't make sense. And yesterday, the exposure to me didn't make sense. And, we will have cases where an option is going to go to zero, right? And yeah, the algorithm will say get out, but it's not going to make any sense to get out. Why? Because the exposure is zero. So there's no reason to sell it, right? And those are the types of cases where I will step in and, the unusual circumstances where I will step in and change a trade. It'll never be for just, a little bit here, a little bit there, that type of thing. It will always be for that exposure, or almost always be for that exposure element here. Okay. Alrighty. Thanks for hopping on. Have yourselves a fantastic day. Again, I will not be on video here this afternoon. I will post a little bit later in the message feed a past video on day trading in more volatile markets like what we are stepping into right now. So look out for those. And then on Monday, we'll do the 60-day summary, break down all the stats for the challenge, where it is, what pace it's on, and what I expect here for the last 6-7 weeks of the challenge. Again, thanks for being with us. Have yourselves a fantastic day, and we'll talk to you later. Take care.